Did you know there's a way to buy a house today using interest rates from, say, 2021? In 2021, interest rates hovered in the 3% range, in some cases even less. Wouldn't you want to know how to buy a house in today's market at a 3% interest rate? Well, I'm going to tell you everything you need to know by the end of this video, but to put that into perspective, in today's interest rate market, a $400,000 mortgage is going to give you a principal and interest payment around $2,800. In 2021, at a rate around 3%, that same mortgage will give you a principal and interest payment around $1,700, an $1,100 difference. There's a way to do this, and it's called an assumable mortgage. By the end of this video, I'm going to tell you everything that you need to know about assumable mortgages and how to get one. An assumable mortgage is a mortgage where the buyer assumes the contractual obligations of the seller's mortgage. So the buyer would assume the remaining term, payment schedule, and interest rate of the seller's mortgage. Obviously, the biggest benefit is they are assuming the interest rate that the seller likely got in the past. So if you're buying a home today, but you can get a rate from 2021 where they were in the 3% range, that is a humongous benefit for the buyer. Now, what is the benefit for the seller? Well, think about it like this. If the seller knew that their mortgage was assumable and that their rate was 3%, they could then advertise that when they go to list the property. Do you think that they would get more buyers if they could advertise that they were selling their house with an assumable mortgage at 3%? Of course they would. The payment at 3% versus today's 7+% interest rates is dramatically lower and would generate substantially more interest on that property. Now, it's important to note that there are only a few types of mortgages that actually qualify for assumptions or are assumable. They are FHA loans, VA loans, and USDA loans. An FHA loan is a loan that is guaranteed by the Federal Housing Administration. A VA loan is a loan that is guaranteed by the Department of Veterans Affairs. And a USDA loan is a loan that is guaranteed by the U.S. Department of Agriculture. It is also important to note that VA loans are only assumable by VA buyers. In other words, someone who is not a veteran and let's say is qualified for an FHA loan cannot assume a VA mortgage. So how would a buyer know if they qualify for an assumable mortgage or not? Well, the reality is if they qualify for FHA, VA, or USDA loans, they will very likely qualify for an assumption. So if you can get pre-approved for either one of those three, you will likely qualify for an assumption. A buyer can also look up the seller's property on the Registry of Deeds, and most of the time will be able to determine by seeing their mortgage online if that mortgage is assumable. How would a seller know if their mortgage is assumable? Well, on the seller side, if they know they have an FHA, VA, or USDA loan, they could probably assume, no pun intended, that that mortgage is actually assumable. But they should reach out to the servicing department just to double check. If they have a FHA loan, they can actually call 1-800-CALL-FHA and they can get that question answered over the phone. So let's run through an example that helps illustrate how an assumable mortgage would work. Let's say that in 2021, Colonel Brown purchased a property for $500,000 with a VA loan at a 3% interest rate, and he has $485,000 remaining on the mortgage. In 2023, he goes to list his property at $550,000 with the remaining balance of $485,000. Major McDonald wants to come in and purchase that property for $550,000 and assume Colonel Brown's mortgage of $485,000 at 3%. This can be done as long as Major McDonald can come up with the $65,000 principal balance difference, which is essentially like the down payment, plus any closing costs, property taxes, and insurances, or any other money owed at the time of closing. This perfectly illustrates a win-win situation for both the seller and the buyer. Colonel Brown gets to list his property with an assumable mortgage, generating more interest, and Major McDonald gets to assume the 3% interest rate at the remaining term when current market interest rates are 7% plus. perfectly illustrates a win-win situation for both. There are fees associated with assumable mortgages, although I think you'll find that assumable mortgages are actually less expensive than your traditional mortgage. You would need to contact the seller's servicing company to figure out what their assumption fee is. My guess is this is going to be very similar to an origination charge on a regular mortgage. Most assumable mortgages won't require appraisal fees, so you're going to save some money there. Appraisal fees can usually run $500 to $1,000. Again, you would need to contact the seller's servicing company to find out if they're going to require an appraisal or not. As far as the timeline is concerned, most assumable mortgages can be assumed within 30 days, which is very similar to the closing time frame on a traditional mortgage. So now that you know what an assumable mortgage is and how it works, what are the next steps? Well, the first thing that you should do is get pre-approved in general. Remember, at some point down the road, if you're looking to make an offer on a house with an assumable mortgage, you will need to get qualified by the seller's servicing company. But it'd be good to know right now if you're pre-approved in general. How do you get pre-approved? I'd be happy to help you out with that. You could simply message me directly, reach out to me, contact me any way that you'd like, or fill out an application on my website. Once you are pre-approved, the second thing that you should do is contact your realtor and let them know that you are interested in making offers on houses with assumable mortgages. Don't be surprised if they have no idea what you're talking about. Most realtors don't. Most people in general don't know what an assumable mortgage is. Feel free to have them reach out to me directly or shoot them this video. Third thing that you should do is identify houses that you're interested in making offers on in general. Once you find a house that you are interested in, look up that property on the Registry of Deeds and find out if the mortgage associated has an assumption clause. If it doesn't, or you can't find it, you can have your realtor contact the seller's side and ask them to figure out if their mortgage has an assumption clause. Once you find the house that you're interested in with an assumption clause, fourth thing that you should do is then contact the seller's servicing company to start the qualification process for the assumption. Thank you so much for watching. I hope you learned a little something. Do me a favor, tap that like button and subscribe for more videos.